The first piece is to keep more money and to live within your means. You can budget, but budgeting sucks, so there's two other ways to live within your means. The second way to live within your means is to be more efficient. So, the first piece is to keep more money and to live within your means. You can budget, but budgeting sucks, so there's two other ways to live within your means. The second way to live within your means is to be more efficient. Simply, there's 4 I's to efficiency. The first I is don't tip the IRS. The IRS is taking money from 93% of you that they don't require, but you're voluntarily handing it over because you don't have all the tax strategies. Number 2, the second I, is interest. If people have more than one loan, there's an 80% chance that they're paying more interest than they need because they either don't have the right credit score, the right collateral, or the right connections, or the right cash flow reporting. And it doesn't even mean that you have to refinance sometimes. Sometimes you can streamline that or renegotiate that and put more money in your pocket. The third I is investments. There's 2 ways that people become less efficient with their investments that are so substantial that if you could correct these 2 things, you're gonna have a ton more money. Like, in the world of investing, we usually get to hear about percentages. Like, they love percentages because percentages make us feel like it's not a big deal. Like 1%, that's no big deal. Unless you're in the world of sailing and you're gonna go like from North America and you're gonna go across like the Atlantic Ocean and try to get to Britain. If you're 1 degree off, you're just in the wrong hemisphere. No big deal, you know? It's the same thing in your finances. So if you had $100,000, you invest that for the next 30 years and they show you this stupid lie called 10% in the stock market year in and year out, that grows to 1.74 million. That sounds awesome. Now, what if you have 0.8%, so less than 1%, in non-performing fees? Like non-performing fees like legal fees, admin fees, 12B1 fees, which are marketing fees that you pay to the mutual fund companies, or certain expense ratios for fund managers that aren't doing their job or they're not beating out the other indexes. Now, instead of having 1.74 million, you have 1.4 million. That's a $340,000 cost because of an undetected, unnoticed fee that sounded so small because it was a small percentage, but it's exponential. If compounding interest is a miracle, guess what? Compounding cost miraculously cost you a ton of money. Now, what if you only get 8% because you have this in some kind of retirement plan in addition to being in mutual funds and those kind of investments? Now it only grows to $1 million. So that's a $744,000 cost because of 2%. So I've got this whole financial nerd network is what I like to call them because they are financial nerds and they are proud of it, like they wear it with a badge. And they're like human ATMs. They're like financial detectives to find out where those things are so that you stop paying for non-performing things and keep that money in your pocket. Now the second part of the third I is downside protection. Do you have a trailing stop loss? If you've invested in someone's business, do you have a UCC filing? If you've invested in some type of other investment with a private individual, did you add some degree of collateral? I mean, think about the financial institutions. When they were up here on the panel, they called a stated loan a stated lie loan, which it typically is, right? Like, oh yeah, I didn't make enough money to get this loan, so I'll just tell you I make more than I made. Now, that's when the banks get in trouble, but when the banks want to be secure, they think of a couple things. Number 1, what can they do to protect their downside? They're not good at real estate. They're not trying to get into real estate. So what they're looking at first is your credit score. Then they look at your taxes, right? Then if you're going to get that property, they're going to make you pay for an appraisal. And even after you pay for an appraisal, they want you to put 20% down, otherwise they charge you PMI, private mortgage insurance. And I can go on at the ways that they're protecting their money. Why is it then that they tell us it takes money to make money and high risk equals high return when they're doing the exact opposite? It doesn't take money for them to make money, it takes your money. And they tell us 10% is a good return, but if you're only getting 1% on a savings account and they lend that money out for as little as 2%, what rate of return do they have? 100%. They borrowed your money, not even theirs, for 1%, and they sold it for 2%, and if they screw it all up, then what happens? You pay taxes to bail them out. Do you see that there's a completely different set of rules that they're abiding by? I'm not saying that they're wrong and that they're evil and that they're bad and that we need to not use them. We need to not be used by them. Rig the game in your favor. Start earning interest rather than paying them interest. Start to learn about cash flow banking. You got the book, What Would the Rockefellers Do? It's in your bags. It shows you how you could boost that 400 to 800% on return, protect it from liability, and then increase and boost your cash flows 20 to 50% in the future because you use a coordinated strategy with all of your assets. Should I talk faster, do you think? I was just wondering. So we're 3 I's in, all right? We got IRS. 93% of people overpay the IRS by $11,430 for every $500,000 that they make if we throw out the people that way overpay. The second thing is interest, and we have a process called cash flow optimization where we find $2,484 per month of lost money just through not differentiating expenses, not understanding what things are destructive to eliminate, what things to address and increase, and then how to restructure loans and renegotiate. The third one was investments. We talked about the fees on that. And the fourth one is insurance. If you have duplicate coverages, improper structure, this is where people lose money on insurance. So of the 4 I's, let me spend some time on the thing that will provide a huge rate of return for you now. You can put these things on the ground in the next 24 hours. I'll kind of build the framework inside of that, then I'll finish out the rest of the 5 levers to economic independence. So on taxes, here's 2 things to avoid. These are the 2 biggest traps that are out there. The first one is deferring your taxes. If the government owes between 19 and $20 trillion, who thinks in the long term we're going to see taxes go down by a show of hands? Who thinks 20, 30 years from now we're going to have a lot lower tax rate than we have today? 0. Okay, 0 people. That's a concern to me. And if you decide that you're going to put money in a government qualified plan, you've just invited the worst partner into your life that exists in the world. Want to know why they're a bad partner? Because they say, okay, you put the money in, I'll be your partner, I'll take 40%, but if you get out early, I'll take 50%. And in the future, I might take a bigger percentage based upon my economic circumstance. I don't know what it's going to be, but right now I'm $20 trillion in debt. Who's ready for that partnership? Show of hands. Right? That's the trap. That's the trap. Deferring taxes is not saving taxes, it's deferring taxes. Don't get caught in that trap. The second trap, early on in my financial career, before I understood what I understood today, I remember I'm a newlywed and I tell my wife, hey, we're going to get rid of your little red Infiniti car that you love, because there's this obscure thing called the Section 179 for vehicles over 5,500 pounds, where we can write it all off in 1 year on the purchase price. So we're going to buy a Chevy Tahoe, even though we don't have kids and I just work all the time so we don't go to the mountains or anything, but it's going to be a great idea to buy a depreciating asset to save tax. See, my wife told me I was a jackass and it turns out she was right. I just thought it was hurtful she said that. So don't borrow to consume. Don't borrow to go get a depreciating asset, but most importantly, don't let the tax tail wag the dog. It doesn't make sense to spend $1 to save 40 cents. So don't defer and don't just spend. So here's the 3 things to do around your taxes. I'm helping you navigate thousands of pages in just three-piece framework. Here's the deal. If we can save you 10, 20, 30, or a bunch of tax per year, that's the equivalent of scrimping and saving money for decades to create that same amount of cash flow. But let's do that in the next 5 minutes. You guys in? I'm going to go fast, take down the notes, and here's the deal. I'll go a little too fast, and then I'll just let you guys get some free stuff. Is that cool? If I just I'll just put it up where you can text this number. You can text 44222, the word independence, and I'll pull it up on a slide here, 44222. And then you text the word independence, and what it's going to do, I know that's only 5 numbers, if there's any old school people in here, and normally you got to have 7 or maybe 10 if you have like like an area code, but 44222, the word independence, and what it's going to do is give you our Wealth Factory Mega Kit, and we actually brought a team here so that if you want to meet with them and talk to them one-on-one about your personal situation, so it's tailored and customized to find out where you might be losing or leaking money, they'll do that for you. I'll make sure you get a copy of Killing Sacred Cows since I gave you the copy of What Would the Rockefellers Do. It's the 9 prevailing myths that harm entrepreneurs that are the hardest things to detect, but once you detect them, you can avoid them and not have your wealth confiscated over and over as most people do in their life that harms their legacy. Cool? All right. I'm glad I got one huge fan. I love you, whoever you are. Yeah. Thank you. Woo! Making me feel good. All right, let's go. This is going to be quick. Number 1, first thing is simple, but don't discount it because it's powerful. You've got to have a tax team. The first person on your tax team is a bookkeeper. The second person is a CPA. And here's the deal. It's hard to find the right CPA, but you need someone that is actually a strategist, not a filer. A tax filer doesn't help you. If you're doing multiple millions, you need a tax attorney, and if you own your own commercial building, you need an engineer. There could be up to 4 people on your tax team. Now, you want to be proactive with them, and every single quarter, get on the phone with them and have a brainstorming session. Your job is not to be bridled or limited by the tax code, but just throw crazy ideas out there and have them tell you why that could work or why it can't. Like when I went to Italy this summer for a couple months, I said, I want to write that off. He says, you can't. I'm like, okay, I'm going to have a mastermind while I'm there. I'm going to have David over. I'm going to film some things. I'm going to write a book. I just think better in Italy. I'm going to meet with my wife, and she's part of my corporation. And then all of a sudden, 50% of the trip becomes a write-off by the end of the call. Okay, so you want to brainstorm. Now, the second thing is, you want a different set of eyes on your taxes every 3 years, because if you've missed, you can go back and amend. In 2006, I had 2 business partners die in a plane crash. And I did not get proactive. I didn't talk every quarter to my tax team. I didn't get any information over to them. And I found out in 2008, I had overpaid my taxes $54,000. So instead, the government wrote me a check for once, and I got that money back. So you can amend your returns back up to 3 years. So that's part 1 of the success framework around tax. Part 2, you want to turn all of your expenses that can be legally turned into deductions into deductions. Here's your number 1 question. How does this relate to my business? If it relates to your business, documentation is the key. Let me give you some examples. You can pay your kids $6,300 if you have kids under 18, and you don't have to pay taxes on that as long as you can think of things for them to do, including a $2,500 modeling fee would work if you put them on a website or something like that. Or maybe you just have them walk out here on stage with you like Ryan did, you know? Like I've done that with my kids. So you find ways to pay him. Another thing that you could do, who here knows the Augusta Rule? Well, my clients, that's weird. Oh, my clients just raised their hand, that's cool. All right, Augusta Rule is a big one because if you use your home 15 days or less in the year for a business purpose, employees, vendors, clients, you can rent that out to your business. The business writes you a check. You don't have to claim that as personal income, but the business gets to write it off. So calculate that. If that's, let's just say it was $2,500 you're charging per time. If you're in Austin, you do it during South by Southwest, you charge $7,500 at that time. You do it during Austin city limits, it's another time. You just look at what would it cost to get a hotel, or what would it cost to get a banquet room, and then you charge that. There is no tax to you, but you write it off in the business. So that right there could be worth $12,000, $13,000, $14,000, $15,000 in something that simple as we talk about it today. Or even simpler things is like having a home office, you can write off half your utilities, or other simple things that you can turn expenses into deductions. For me, I set up an intellectual property company. Now that intellectual property company, part of its intention is to put things on video, which means I now buy uniforms for that. And when I'm at home, I sit in Lululemon. I don't work out in it, I just sit in it because it's super comfortable, And then when I'm on stage, I wear this kind of stuff, and now that's a uniform that I'm writing off. Turn your expenses into deductions. If you have a company, you need to have an annual meeting. I think better in exotic locations. So I always have my annual meeting, like at Whistler was our last one. We've done Hawaii, we've done Italy. We write that off. There's so many things, and the IRS says that the majority of you are not taking all of your tax deductions. Why? Because you might have an accountant that says they're conservative. Anyone have that accountant that says they're conservative? Here's what they're saying. I'm antiquated. I'm having you overpay your taxes because I don't know everything there is to know out there. And they scare you into thinking that that's gonna, you're gonna get in trouble and there's gonna be red flags. But a lot of this is just so freaking simple that for some reason they're not doing it. Depeche, how many things are your accountants missing, that you bring to them back in the day? So you had to go get a whole new team, right? Like it's just how it works. So the third one, and this is where you're gonna save a boatload of money, is to reclassify your income. The way you reclassify your income, turn active income into passive income. That's really powerful. Active income into passive income. How do you do that? If you're not incorporated, you can set up an S corporation and differentiate your income. You take a reasonable salary, which isn't what you're worth, but what you'd hire someone else to do that job, and then you can take the rest in distributions, and distributions don't get hit with self-employment tax. That's 15.3% savings. Even when you max that out, it still saves you 3.2% on Medicare, Medicaid, and it saves you above $250,000 on an additional 3.7%. So somewhere between 3.2 and 15.3% just because of how you paid yourself, even if it was the exact same amount. Or we heard about captive insurance agencies earlier. I have a captive insurance agency personally. I can put money into that pre-tax. If I don't have an insurance claim, when I take that out, it's a capital gain. So I just took ordinary income and turned it into capital gain, which almost cut my taxes in half. That's reclassification of income. Other ways to reclassify your income. Let's say you own real estate or you have a building that you're a tenant in and you own the building, charge yourself the highest possible rent because that's going to come through at a lower tax rate than if you're paying yourself a salary. If you own real estate, that can help you reclassify your income because you can become a real estate professional, which doesn't mean licensing, it means how much time you spend on it, and you get unlimited deductions with that. There's so many things that you can do in this realm. For example, you can set up a C corporation, and if you have a new startup business or a part of your business that you have like a division, like if you're a doctor and you see patients, but then you want to do supplements, you can put that in a C corporation and you pay less tax on the first $50,000 in the C corp than you do on an S corp or an LLC. Or another way you reclassify your income. If you're the only owner in an LLC, you're not being as tax efficient as you could. What you do is you put at least a 1% partner in there, even if it's a spouse or something like that, and then you move to Schedule K, it gets taxed as a partnership, and it lowers the taxation on that. So reclassifying income is a major, major way that tons of people can save money. Like if you live in a state, anyone live in a state like California or New York, or where you're just paying a boatload of taxes, but you have clients outside of those states, you could learn about a grantor defective trust called a wing in Wyoming or a ning in Nevada and avoid state tax on people that are from out of your state that you're serving. I mean, I could go on for hours, but just text that number there, 44222, and grab the guides so that you have those resources to go into more of that. So that's the first piece, was just the IRS of the 4 I's. So we have IRS, we have interest, we have investments, and we have insurance. That's how to be more efficient. So we talked about 2 of the 3 ways to live within your means. The first one, we all agree, sucks. It's budgeting. Now, there's someone in here that loves budgeting. Who is it? It's cool. I'm not going to steal it from you. You get to still budget if you really want. But the rest of us, you never have to budget again if you do this simple thing. Go to your bank, set up a separate account. Call it your wealth capture account. Every time you free up money, every time your business grows and you pay yourself more, just make sure you're automatically paying a portion of that money into that separate account called the wealth capture. That's automatically saving money. Now, most people think they're automatically saving money, but if you're putting it into an investment, that's not saving, that's investing. And I'm in agreement with other people on the panel. Now is the time to start building up a lot of cash, because people that build up a lot of cash are going to be able to take advantage of the change in the economy. The people that are going to get wealthiest in the near term are not the ones that are chasing the stock market returns, but the people that are sitting in cash that when the stock market finally starts going down and everybody else is like, when do I sell and realize that loss? And now they get into scarcity. Now they're just trying to make ends meet, and they probably got really addicted to a better lifestyle than they deserved because it wasn't about value creation, it was about luck. That's when you can pounce and start buying great opportunities. Businesses are going to be on sale for a different level. Opportunities are going to show up. Like when McDonald's grew massively was during a recession, and they started to buy real estate that they couldn't get before the recession. When Apple started to grow massively is when they started to acquire companies during times when everybody else was cash strapped and they were cash heavy. Start to build up that cash, because rookies always stay invested. They invest early, always and often. They're told to be mindless drones that dollar cost average, that wait for 30 years, that they're in it for the long haul, but instead professionals sit on cash and then they pounce when the opportunity is right. I want you to be a better investor. I want you to use your investor DNA, only invest in things that you know, and try to avoid the greed gland when you feel like you're missing out, because that's about the time everything's gonna start happening and turning, because that's when the mass hysteria comes in. Like, have you ever heard of tulip mania? Anyone heard of that? There was a time where tulips were the most expensive commodity in the world because of the hype around tulips. Like, that's some dumb shit.